Options trading can seem daunting for beginners. Many are drawn to the allure of buying options, enticed by the potential for massive returns. However, what they often overlook is the statistical advantage enjoyed by option sellers. You see, when you sell an option, you're essentially betting against the odds. Think of it like this: every option contract has an expiration date. The vast majority of options, statistically speaking, expire worthless. This is because the underlying asset, whether it's a stock, index, or something else, simply doesn't move drastically enough in the anticipated direction within the given time frame. This phenomenon works beautifully in favor of option sellers. By selling options, you're essentially collecting premiums, much like an insurance company collects premiums. You're being paid for the risk you're taking on, and since most options expire worthless, the odds of consistently profiting from selling options are significantly higher than buying them. Remember, time decay, also known as theta, is the option seller's best friend. As each day passes, the value of the option erodes, working in your favor. However, don't mistake this for a get-rich-quick scheme. Option selling involves its own set of risks, and it's crucial to approach it with a well-defined strategy and strict risk management principles. We'll delve deeper into these aspects in the upcoming sections. The world of options trading offers two distinct paths: buying and selling. Each path comes with its own set of risks and rewards, and understanding these differences is paramount before diving in. Let's break down these two approaches. When you buy an option, you're essentially buying the right, but not the obligation, to buy or sell an underlying asset at a predetermined price, known as the strike price, on or before a specific date, the expiration date. Your potential for profit is theoretically unlimited if the market moves significantly in your favor. However, if the market moves against you or remains stagnant, you stand to lose your entire investment, which is the premium you paid for the option. Selling options, on the other hand, is a different ballgame altogether. When you sell an option, you're essentially taking the opposite side of the trade. You're obligated to buy or sell the underlying asset at the strike price if the option buyer decides to exercise their right. While your profit potential is limited to the premium you receive up front, the probability of making a profit is statistically higher. Think of it like this: buying options is like swinging for the fences, high risk, high reward. Selling options, however, is more like playing defense. You're aiming for consistent wins by capitalizing on the statistical advantage. It's crucial to remember that both strategies have their place in a well-rounded trading approach. The key is to determine which strategy aligns better with your risk tolerance, financial goals, and market outlook. Now let's venture into the world of futures trading and span margin, as they play a crucial role in understanding options selling. Futures contracts, unlike options, obligate the buyer and seller to complete the transaction of an underlying asset at a predetermined price and date. They are often used by traders and investors for hedging or speculating on the future price movements of assets like commodities, currencies, or market indices. Span margin, which stands for Standard Portfolio Analysis of Risk, is a widely used margin system employed by clearinghouses and exchanges to determine the minimum margin requirements for futures and options positions. It's essentially a risk-based calculation that takes into account various factors, including market volatility, contract size, and the overall risk profile of your portfolio. Understanding span margin is crucial for option sellers because it directly impacts your buying power and risk management. When you sell options, the margin requirements are typically higher than when you're buying options. This is because selling options exposes you to potentially unlimited risk, and the margin requirements act as a financial safeguard. The key takeaway here is to be aware of the margin requirements associated with your options positions. Always ensure you have sufficient capital in your trading account to cover potential losses and margin calls. Remember, responsible trading involves understanding the intricacies of margin and leveraging it wisely. In the realm of options trading, selecting the right strike price and expiration date is akin to a general choosing their battlefield. It can be the deciding factor between a triumphant victory and a costly defeat. Let's delve into the intricacies of these crucial elements. The strike price, as you might already know, is the predetermined price at which the underlying asset can be bought or sold if the option is exercised. Choosing the optimal strike price depends largely on your market outlook and risk appetite, If you're bullish on a particular stock, you might consider selling put options with a strike price below the current market price. Conversely, if you're bearish, selling call options with a strike price above the current market price might be a suitable strategy. Expiration date, the other crucial element, dictates the lifespan of your option contract. Options contracts come with various expiration cycles, ranging from weekly to monthly to yearly. The choice of expiration date should align with your trading time frame and risk tolerance. Shorter-term options, like weekly options, offer the potential for quicker profits but come with increased risk due to their rapid time decay. Longer-term options, on the other hand, provide more breathing room and are less susceptible to sudden market fluctuations, but their premiums might be higher. Remember, there's no one-size-fits-all approach to selecting strike prices and expiration dates. It's about understanding the dynamics of time decay, implied volatility, and your personal risk tolerance.